As the U.S. markets are closed for the weekend, Rezolve AI PLC, trading under the ticker symbol RZLV, finished Friday's session on October 3, 2025, at a price of $6.79. It was a volatile day of trading, with the stock experiencing a high of $7.58 and a low of $6.73, ultimately closing with a gain of over 8% on exceptionally high volume. Now, the initial reaction to that kind of single-day performance, especially in a tech name, is often one of bullish excitement. The expectation is that this is the start of a significant upward trend, a sign that the market is finally recognizing the company's potential. But the reality of Rezolve's situation is far more complex and layered than a single day's trading activity might suggest. This isn't a straightforward growth story like you might see with an established player, and understanding the real drivers here requires looking past the surface-level numbers. The common belief surrounding a company like Rezolve, which came to the public market via a SPAC merger with Armada Acquisition Corp. I, is often colored by the broader narrative of AI stocks. The market has been rewarding anything associated with artificial intelligence, sometimes indiscriminately. The expectation, therefore, was that RZLV would debut and immediately capture the tailwinds that have propelled giants like NVIDIA stock to unprecedented heights. Investors, many of whom might be managing their portfolios through platforms like Fidelity or SoFi Invest, saw another opportunity to get in on the ground floor of the next big thing. The reality, however, is that post-SPAC entities have a notoriously difficult track record, and Rezolve is operating in a fiercely competitive space where lofty promises must be backed by tangible, predictable results. The recent surge in price isn't a simple validation of its technology. It's a reflection of a recent aggressive push by the company to control its own narrative after a period of significant pressure. Just within the last week, Rezolve has been the subject of intense focus. The company reported its first half 2025 financial results, which presented a classic case of expectation versus reality. On one hand, the company announced a staggering 426% year-over-year revenue increase, bringing in $6.3 million for the half. That's the kind of headline number that gets algorithms and retail traders on platforms like Robinhood excited. They also beat adjusted EBITDA estimates, reporting a loss of $17.7 million against an expected loss of $18.7 million. But beneath that, the company actually missed quarterly revenue consensus, bringing in $4.88 million versus an expected $6.75 million. The stock's subsequent rally, therefore, wasn't about the reported revenue, it was about guidance. Management didn't just reiterate their outlook, they aggressively raised it, projecting a minimum of $150 million in annual recurring revenue, or ARR, by the end of 2025, and setting a bold target of a $500 million ARR exit rate for 2026. This is where the core tension lies. The market is being asked to ignore the current revenue miss and instead price the stock based on massive, future-looking projections. This forward-looking optimism was further amplified by a coordinated announcement that 6 equity research firms, including Maxim Group and Roth Capital, had raised their price targets on the stock. This flurry of positive analyst ratings, coupled with the aggressive ARR guidance, created a powerful narrative countercurrent to the underlying revenue miss. It's a strategy designed to build institutional confidence and attract new investment. And it appears to be working. In September, the company announced that institutional ownership had surpassed 10%, with major players like Citadel, BlackRock, and Vanguard taking positions. For a small-cap post-SPAC company, attracting that kind of capital is a significant validator and provides a stark contrast to the skepticism that often plagues these types of stocks. When you see names that typically anchor large-scale Fidelity mutual funds or Schwab Intelligent portfolios starting to appear on the cap table of a company this size, it forces a re-evaluation. It suggests that the sophisticated players see a valuation disconnect, which the company itself has been keen to point out, comparing its revenue multiple to much more richly valued private AI companies. So what exactly does Rezolve AI do? Stripping away the market noise, the company operates in the AI-powered e-commerce space. Its core offering is the Brain Suite, an enterprise AI platform designed for what it calls agentic commerce. This platform uses a proprietary large language model named BrainPower, which, unlike generalist models, is specifically trained on retail and commerce data. The goal is to provide a more accurate, context-aware, and effective AI assistant for online retailers.
powering everything from highly personalized product searches and recommendations to seamless one-tap checkouts. They claim their model avoids the hallucinations common in other AIs, which is a critical feature for enterprise clients who cannot afford to have an AI recommend non-existent products or provide incorrect information. Rezolve is now serving over 100 enterprise customers, including major brands like H&M, Urban Outfitters, and Office Depot. The business model is primarily SaaS-based, built on generating annual recurring revenue, which is why the ARR metric is so central to their investment thesis. Success here isn't just about one-time sales, it's about embedding their technology into the core operations of major retailers and creating a sticky, long-term revenue stream, something every investor looking to self-invest online is seeking. This brings us to the future outlook, which is a landscape of both immense opportunity and significant risk. The opportunity is clear. The global retail market is a multi-trillion-dollar industry, and the integration of effective AI is no longer a luxury but a necessity for staying competitive. If Rezolve can prove that its brain suite genuinely drives higher conversion rates and customer loyalty, its potential for growth is substantial. The company ended September with approximately $230 million in cash after 2 recent financing rounds totaling $250 million. This gives it a significant war chest to fund global sales expansion and potentially pursue further acquisitions to bolster its technology stack. The company is also signaling a move into new payment infrastructures, including crypto, which could open up new verticals. With the company guiding for profitability by the first half of 2026, the path forward as presented by management is exceptionally bright. For those using investment sites to find the next big growth story, Rezolve is certainly making a compelling case. However, the reality is that the path is also filled with obstacles. The intense competition in the AI and e-commerce sectors cannot be overstated. Rezolve is not just competing with other startups, it's competing with the in-house AI development of giants like Amazon and the extensive enterprise offerings from Microsoft and Google, with whom it also claims strategic partnerships. The recent revenue miss, despite the positive spin, raises legitimate questions about the predictability of its sales cycle and the lengthy 7 to 9 month conversion time from ARR to recognized revenue. Furthermore, the company is facing legal challenges. There are ongoing lawsuits related to a failed $1 billion Bitcoin financing agreement from earlier in the year. While the company dismisses these as meritless, litigation creates overhang and uncertainty, consuming resources and management attention. There has also been a short seller report from Fuzzy Panda Research that questioned the company's AI capabilities and revenue growth, which the company has refuted as misleading. This combination of operational execution risk, intense competition, and legal battles creates a high-risk profile. This isn't a stock for a conservative individual brokerage account focused on blue-chip stability like Apple stock. It's a high-stakes bet on execution and market adoption. I'm curious to know what you think about this balance of risk and reward. Comment below on whether you believe Rezolve's aggressive 2026 guidance is achievable. In conclusion, the story of Rezolve AI is a fascinating microcosm of the current market environment. The expectation, fueled by the broad AI hype and aggressive management guidance, is that of a company on the cusp of exponential growth, an undervalued gem ready to close the valuation gap with its peers. You have a narrative supported by rising institutional ownership and a flurry of upgraded analyst price targets. But the reality is that of a young, post-SPAC company that still has a great deal to prove. It has shown impressive top-line growth and has attracted marquee customers, but it has also missed revenue expectations and is navigating complex legal challenges. The recent stock surge is less a reflection of proven consistent performance and more a vote of confidence in the company's future promises. The tension between the current financial reality and the forward-looking expectations is palpable. This isn't a simple buy or sell, it's a complex situation where investors who use platforms from interactive brokers to SoFi Invest must weigh the allure of a potentially transformative technology against the very real risks of a business in its high-growth, cash-burning phase. The coming quarters will be critical in determining whether Rezolve's reality can finally catch up to its very ambitious expectations.